Hey, welcome to Let's Talk Money with Money T and Simply C.
We will be discussing financial behaviors, past experiences, relationships, and more. We're going to show you how all those things play a role in your financial decisions.
Talking about spending plans, saving and investing, and identifying your behaviors with money.
All of these things will help you jumpstart your road
to financial freedom.
Living just enough for the city I'm living all my life.
Hey, welcome to Let's Talk Money with Money T and Simply C. So what we got going on today, T?
So today we have a special guest, another dear friend /
brother from another mother.
Yes, that's going to talk to us about insurance, life insurance. He's an agent, a broker of 30 plus years, licensed in 8 states, including Texas, Kansas, and Missouri, representing 15 major carriers. He think he hot. He think he hot.
You tight.
Yes, but before I bring him on, I want to talk about something I read. It's a little statistic regarding insurance ownership gap. Before the pandemic, close to 46% of U.S. adults consumers did not own life insurance, while 35% of respondents said they intended to purchase life insurance in the next 12 months. Many were without it during the height of COVID-19 in the U.S. Lack of ownership may be adding to mounting financial stress amongst Americans.
Wow.
Almost 44% of those surveyed stated that they would feel a financial impact within 6 months if the primary wage earner were to pass away. More than a quarter, 28% would feel it within 1 month.
Wow.
Yes. That is crazy. So it is so important to have life insurance, and Randy is going to tell us all about that. Welcome, Randall Fears.
Woo, 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 woo.
Good morning. Good morning. So glad to be with you all on today.
Well, thank you for joining us.
Glad to have you.
Well, kind of be with you today,
Yeah, right. Yeah.
So, Randy, why don't you just start by telling us the benefits of having life insurance and why it's so important?
Well, I'll start out by saying this. One of the reasons that I got into business 30 plus years ago was because I felt like so many people did not know the importance of it. I was actually young and had gotten married, and somebody came to our house and was talking to us about the life insurance. And I started thinking about it. I was like, wow, I'm married. I have a young child. I had 2 children. I said, if something happens to me right now, what happens to the family? He had just bought a house, and so it kind of intrigued me. And when I was talking to the gentleman, he said, you can do this. He said, but it was more of an education thing when it started out because I wanted to let people understand the importance of it. But sadly, like was just mentioned, a lot of people don't have coverage. So I think the number one thing that it does is it provides financial stability to the family in case someone is to pass away early, whether it's a husband and wife or just a single a mom and single parent. Life insurance is so important because really what it does is it replaces the income that the wage earner was going to make if you're taking out a picture. We always say that there's an if, L-I-F-E, there's an if in the middle of life. And so you have insurance just in case something happens that your family is taken care of.
Right. So it's more than just being able to afford to bury someone. It's that even bigger picture of if you were to lose someone that makes money within the house too, to cover cost of living.
Right.
Yeah, I remember.
It's a perception thing. Yeah.
Yeah, I remember when we first got life insurance. We were probably about 30 years old at that time, and my idea then was that if something were to happen to me, I didn't want people struggling to take care of my kids. So that's why, we got insurance at that time, just discussing that and saying, I wouldn't want my mother. I know she would take them, but I would not want her struggling to take care of my kids. So that's why it was so important to me at that time.
Right. And I think a lot of times, especially in the minority community, because of the way insurance is sold.
Randy, are you covering up the phone?
Can you hear me?
Now
yes,
I can.
All right.
It must be trying to hold it like a pal.
Well, I got a cramp right here, so shut up. But back in the day, there used to be what we call debit policies, and people would go door to door, and they would only sell minorities very small policies, and they would collect the money cash. And so our perception in the community was that when we thought of insurance, it was like $1,000, $2,000, because that's all that they would sell minorities.
What?
Where on the other side of the river, they were selling $100,000 and $150,000 policies. So when I go talk to a lot of older people, they have a $500 policy. They have another $1,000 policy. They have very small policies. And so our perception just became life insurance is only for burial. But that's not the case. People buy life insurance for many reasons.
Wow.
So can you tell us the difference between whole life versus term life insurance?
Sure. And I think that the what I'll do is there are probably two general categories, and then within that there are a lot of other subcategories. But term insurance is pretty much what we call temporary insurance, where you can buy it for 10 years or 15 years, 20 or 30. And now some companies even have 40 years. And what you're doing is you're basically paying a premium, a monthly fee for a death benefit. So it doesn't build any cash value. It doesn't, it's not a guaranteed lifelong policy. So if you outlive that term, you wouldn't have that coverage. But it's the least expensive way that you can buy a large amount of coverage. And typically term insurance is used for income replacement, or it might be used as a buy-sell agreement. It might be used for mortgage protection. An example would be a 30-year-old could buy a $250,000 30-year term policy for $21 a month. Okay. Or you might be able to buy a 30-year-old could buy $500,000 a term if they're in a good health for $32 a month.
Wow.
For 30 years. So for the price of a dinner, you're covering your family for $500,000.
That's a good way to put it. The price of a inexpensive dinner. Yeah.
Yeah. And people go, oh, but I don't want to pay that. But because nothing's going to happen to me. And I'm like, I said, how long would you have to put away $30 a month to come up with $500,000 of cash?
Right.
So what you're doing is you're taking a little piece of the dollar and you're giving it away to cover the whole income, and it would cover it for a number of years if there was an unfortunate accident or death. Whole life, on the other hand, typically, I can explain whole life is kind of like buying a house. I always say term insurance is like renting an apartment. You don't plan to live there forever. Whole life, it basically says, I'm going to have this policy my whole life. All right. All right. And many times I tell my clients, and when I'm talking to people, whole life is more expensive because it's actually an asset. You actually build equity in that policy, and you actually own it. So think of it as like a mortgage. When you buy a house, there's more upfront costs. it's a little bit more expensive, and you own it for, you own that house. So that's the difference between whole life. $30 might buy you $250,000 or $500,000 of coverage, depending on your age. $30 will buy you a small amount of whole life, okay, depending on your age. So policies, we buy those policies for different reasons at different times in your life cycle.
So whole life for a 30-year-old, does it even make sense to do that?
Well, all insurance is based on your age and the health at which you buy it. So I always tell people, number one, good health buys insurance. Okay, so if you bought a $25,000 whole life policy for a child, you're going to pay significantly less, $9 a month, $10 a month, okay, as opposed to a 65-year-old buying that $25,000 of coverage who might now be diabetic, who might now be overweight.
Right.
That person might pay $120 a month. Okay, and just like houses, you can buy whole life policies for, you can pay for them over an entire lifetime, or you could choose to pay for it over 30 years, over 20 years, over 10 years. So you can actually pay for and have that policy paid for a young child. You bought it for them when they're age 2. You could have it paid for by age 12, and they would never have to worry about paying for it again. Okay.
I love that.
So what if you all had a house that somebody paid for and gave it to you, all right, and you didn't have to worry about a mortgage anymore?
That would be amazing.
That's the same way it is.
Hallelujah.
Exactly.
Yes. And
just move in the family house.
Okay.
Right. Yeah.
So I said we bought a term life insurance back then, and it must have had been for about 20 years, right? Because it recently expired, and they sent us notification, but somebody didn't keep up with that date. And so my husband had like 350,000 and I had like 150,000. And so when it expired, I just happened to check my account that day, and the insurance company was withdrawing it was $56, $56.91 or something like that a month for those 20 years. And it was expiring. I didn't pay attention to it. I went out there and they were withdrawing $460-something.
Crazy.
So in order for us to retain the same amount of coverage, can you just crazy? Did that quadruple
right.
quadruple time? Yeah, just to keep the same amount of policy.
I have a question. Would you tell us how much insurance should a person have? Jeez.
Okay, and then that question is kind of objective because different people have different opinions, but most people would say that you should have 7 to 10 times your annual income. Again, it becomes a cost factor, what a person can afford to. When I talk to people about insurance and we look at assessment, at times I do consider what they have through work. But realize that that's kind of temporary coverage because people should always have a policy outside of work. And most people are going to change jobs like 7 times in their lifetime now, especially millennials, 7 to 10 times. So the group insurance that you get is kind of more like gravy. It's kind of more like a bonus. But you should always have about 7 to 10 times of your annual salary outside of work.
That's good to know. I've never heard that.
Yeah. Is that more younger raising kids typically, would you say? Or just in general?
I would say in general, and here's why I say that: because as you matriculate through your lifetime, you buy insurance for different reasons. In other words, if you have a business and you have two business partners, sometimes those three business partners will buy policies on each other so that if something happens to one of the business partners, then the company can continue to thrive, or they're not going to be in business now with the child, or the remaining spouse, that doesn't know anything about the business. They go ahead and buy them out. But as you make more money, then obviously I think people think that, well, you don't need as much insurance. But rich people use insurance as a way to pass generational wealth, income tax free, to their beneficiaries. And that's the key thing. If you have $5 million of cash, you might say, oh, I don't need any insurance because I got $5 million of cash. But once you pay inheritance tax, estate tax, and then some of those IRAs and things pass on to the beneficiaries, and they have to pay tax on that. Now it's not $5 million anymore. It's maybe $2 million. So what do people do? They go out and they buy a $3 million policy. All right. And what they do is that $3 million is left and it pays the taxes.
Okay.
All the buildings, a lot of the buildings on the campuses of the universities, they have people's name on them. And they say, oh, we got a $20 million gift from XYZ. It wasn't $20 million of cash. What they do is they go out and they might have spent $500,000 to buy a $20 million policy and leave it in the name of their family. And now it passes to that university.
Okay. What is a universal life policy? What's that?
So a universal life policy is like a term insurance policy and savings in a forced savings account in one package. All right. The term amount of insurance in there is an annual amount that goes up each year based on age. So it ratchets up a little bit internally. So if I'm paying $50 a month for the policy, maybe my insurance costs and my fees are $15 a month, and the other $35 a month goes over into the savings side, and it might be earning interest, let's say 3% or 4%. And so as long as I put that 50 in there, I've got money going in the savings that I can use for a rainy day, and I've got the insurance. Okay. I can put more than 50 in, so it's kind of flexible, and that's why they call it universal, because people use it in different ways. It can be universal.
Okay, so is that... I guess, okay, that's good to know. So that's probably more so for people that might have a harder time saving. Because would it be, so my question is that one cost more than a term one? And is it basically just to really help people save money? Also,
it is. It's kind of a forced savings, but I think if you broke it down, you would find that people could buy a term policy probably for less than what the universal was costing them for the insurance part of the universal policy, and then they could put the savings into savings. There's we're not comparing apples to apples because there's always some other fees in there with the insurance costs, because you have the insurance costs and then you have the other maintenance fees and that type of thing. So if you were putting if you were putting the same amount of money just in savings, you would have more, and maybe a term policy, you would probably end up with more in the savings. Okay. But the problem is we go and spend that savings. Right. So the policy has its place because it's a forced savings.
Okay. That's good to know.
Wow. So Randy, can you explain a final expense policy? I had never even heard of one until we started preparing for this show. But I can see how it's important because just recently I know of someone who lost a loved one and received a notification from a hospital or somewhere about them putting a lien on the house because of the expenses that were remaining. So I can see if you can just explain that to the listeners and just how that's important. And is that any different than a life insurance policy?
Well, a final expense policy is, they use what we call simplified underwriting, or they basically are trying to see if a person is not terminally ill or maybe just within the last year of life or something like that. So they have probably 12 or 15 what we call knockout questions. And if a person can answer no to those questions, I'm not in a nursing home, I haven't had cancer, I just recently didn't have a heart attack, then they will give them a policy, and the rates for those policies are higher than a fully underwritten policy. But what it's simplified, meaning you may not have to take a physical, you may not have to get the doctor's records, that type of thing. And so it's a little bit less invasive. And typically final expenses for older people who maybe haven't put enough money away or maybe don't have any other insurance outside of work, and now they're thinking, you know what, I just need to make sure that the expenses for my funeral and burial and all that type of thing are covered. So the problem is that those type of policies, if they're 10 or 15,000, might be $75, $95, $100, $150 a month, depending on the age of which that person buys them. Okay, but if something happens to them, there's immediate coverage from day one if they're accepted, if they're approved.
Mm-hmm.
So how long is that policy? How long are you paying on this policy for $10,000 or $15,000 if you're paying that amount of money?
So it would be it's a continuous pay or a lifelong pay.
Oh.
So if somebody buys that at 75, okay, then if they're paying $90 a month for it, okay, then it's going to give them that $15,000 of coverage, and we were throwing out some numbers to give them that $15,000. Now, the amount of the policy might ratchet up a little bit depending on, with the growth of the cash value in the policy. So depends on the company that we're looking at and how they're underwritten. Mm-hmm. So a typical question though people would give me in that situation like that is, okay, I'm 75. Should I just go to pay for a plot and pay for, and you can do those types of things as well. Again, the policy is an immediate death benefit from day one, and it's income tax free to the beneficiary. So a lot of times I tell people, okay, if you go to the funeral home or if you go to the cemetery and start paying for that, and something happens to the person in 2 or 3 years, there's still a balance due that somebody has to pay.
Mm-hmm.
Mm.
Yeah.
That's true.
So the earlier the better.
Yeah.
The younger the better.
For sure.
Because good health and youth mean you pay a lot less.
Wow, health is wealth. So have you seen any cases where older people who are in good health get better rates or get good rates?
Mm-hmm. Absolutely. As an agent, one of the things that we have to do, and especially experienced agents are probably better at this, is being able to ask a person to assess their health, so we know what route that needs to be taken. Mm-hmm. And that's what experience. I mean, I didn't know how to do that 20 or 25 years ago. So if you have a person that's older, they're overweight, they may be diabetic, they may have just had, some type of heart surgery or something like that, you already know they're uninsurable. Mm-hmm. Okay? But if it's been 2 years, or if it's cancer, if it's been 5 years, then you have there are different companies that will take a different way. So it really gets to be about health. Mm-hmm. I end up having a lot of conversations with people about their health. There have been some times that, we've actually found out that people had some health consequences that they didn't know about before they applied for the policy. Okay. But the good thing about insurance, too, is that if you have a policy and if you you lose weight or you change your lifestyle, you go from smoker to non-smoker, guess what? There can also be a reduction in rates where you could apply for a policy that's going to cost you a lot less than maybe the one that you've been having.
Okay. That's good to know. Based off a conversation you and I had, I would like for you to kind of talk about the policies or what they're doing now with COVID-19 being present and as far as being approved and things like that.
Sure. Yeah. COVID changed a lot of things, and it kind of helped the insurance industry in a lot of ways, too, because I can't really say that they became more lenient in the process, but what they did was they changed some of the limits so some people wouldn't have to do a physical exam. We're doing e-applications now instead of paper applications. They're looking at the fact that even though a person might have had COVID, if it's been more than 60 or in some companies 60 days, some companies 30 or 90 days, they'll still underwrite that person as a preferred risk. All right. It just depends on the severity of the COVID that they went through. And, you know, it's still underwritten. So there has been a lot of positive changes with regards to that. Oh. They don't always look at, we have a lot of speed underwriting now, where they just look at Medical Information Bureau report, MVR report, prescription report, and if that looks clean, you know, then it's kind of a jet issue.
So this is really the time, basically, to get life insurance on your young adults, teenagers, if you're a healthy middle-aged individual, right?
Right. And it's heightened the awareness of life insurance like we talked about. But also the other thing is it's also, I talk to everybody about convertibility.
So, Randy, anything that might forfeit a policy, insurance policy?
There are some possible scenarios that might cause, I wouldn't, to maybe forfeit or maybe insurance company to may question a policy. And I think number one is there's always a suicide clause in most policies that if a person commits suicide within the first 2 years of purchasing the policy, that the company may not pay the full, may not have to pay the benefit at all. Or may not have to pay the full benefit. And that's spelled out in the policy when people buy it. Also, there is 2 years, in the first 2 years of a policy, there's something called an incontestability period. And all that means that if something happens to a person in the first 2 years of the policy, the insurance company is going to investigate it a little bit more than they would. And normally where they would just maybe, you know, get the doctor's death certificate, you know, and find out about the cause of death. And the reason for that is in the first 2 years, they want to make sure that people answered all the questions. You know, are you a smoker? Do you use tobacco in any form? Some people would say no, but then they come back and they find out that may be true. So you always have to be totally honest when you're buying these policies because the insurance company is on the hook for a large amount of money.
Yeah. So what's the consequence for lying? I'm just saying.
Well, I think I've seen a couple instances where the company returned the premiums that were paid to the family, but did not pay the policy because, and the one I was just mentioning where it was, gentleman was said he wasn't a smoker. He didn't have to take the physical, so they didn't know about the nicotine and urine, that thing, but he actually was a smoker. So he got non-smoker rates instead of smoker rates, and then he ended up dying of cancer.
Wow.
I was trying to put that some cute way, but I couldn't think of nothing other than lying. Well, they was lying.
hey, just tell the truth.
Just tell the truth. Yeah. And I wonder how many people really know that. I know I'm a little guilty sometimes of not reading some things before, because it's so much. It's a lot to read. And usually you're sitting there at the desk, here's this and sign that. And there's a quick summary of what you're signing.
Right.
And so I haven't heard in that summary, because I just got some whole life recently that anybody told me that, okay, don't go out and commit suicide in the next couple of years because we're not going to pay your family for this policy. So I wonder how many people actually tell people that, and how many people start reading your stuff, peoples. We need to read the stuff, and I'm guilty. Like I said, we do need to read and understand what we're signing when we're doing things like this.
Absolutely.
Man,
I can tell you another instance, and I think it kind of piggybacks on what you were talking about. If you buy a term policy, it will say term renewable to age 95 or renewable to age 100. And what the insurance company does is if you're buying a 20-year term, then what they'll do is that first 20 years, it'll be level. Okay, so you're going to pay that price for 20 years. But inside the policy, what it does is it says, come year 21, this is how much it's going to cost, up to a guaranteed maximum of this. Ideally, they don't want you to keep that beyond 20 years, so they price it where people aren't going to keep it beyond the 20 years.
That's what they did to you.
You could.
They did Melanie like that.
But it was my fault.
That's what they did to her.
That's what they did. That's what they did to me. But
so an agent should be pointing that out to you, and so that you can make a move, or make changes before that term, that level term period is up.
Yeah. And Randy, we even talked about how you had multiple term policies, just to make sure that coverage continued at the lower rate. And so that's something maybe people could look at too.
Yeah, people are very familiar with laddering CDs. That was something people did in the 80s and 90s, where they would buy a CD, and when rates were higher, they would lock one in, for a 2-year period. Then 6 months later, they would buy another one. And so it's the same way with life insurance policies. You can actually stagger them if you're buying 20-year policies. I have one that I bought at age 39 that will take me to age 59. $500,000, $40 a month. Okay. But I have another one I bought at 46 for 20 years. That's $60 a month. So you can kind of see where that 7-year period, I try, and so you can kind of see the difference in the rates given when you buy it. It locks it in.
Knees got bad in the
when you're 19 and fine, 21 and fine, and then you lock it in for 30 years.
Right.
Better get another one midpoint.
You skinty, you don't have no health problems.
Knees still good, your back ain't hurting.
Right.
Yes.
All that. Ain't popping no medicine.
Right.
Yeah.
Right. Well, my aunt, I don't think she still take any kind of medication. She take a tablespoon. What she?
Apple cider, apple cider vinegar.
Tablespoon of apple cider vinegar every day.
It cure everything.
Cure everything. That and water. And for my husband, them is water. You could say you told her, did you drink some water? Eric, did you drink some water? But yeah, that's funny.
It's a cure-all.
It's a cure-all. Man. So, Randy, is there any other important items that you think is important with life insurance?
I was reading something the other morning, and it was talking about facing your fears. I think a lot of times people don't talk about life insurance because they are thinking about the inevitable. We're all going to leave here one day. And so would you rather plan for it and leave your family in good financial shape?
Right.
Or would you like to bury your head in the sand and say, I don't want to talk about it?
Right.
In the meantime, the clock is running. You're getting older. Your health is declining. So plan for it.
Yeah.
And, it doesn't mean anything's going to happen to you because You know, and I've also heard people say, I don't want to leave anybody rich. I don't want to leave anybody.
I have heard that too.
Spending money.
I ain't spending all my money.
And I've heard a lot of people say that, and I said, you know what? You're not leaving anybody rich, because if we had 300,000 or 500,000 right now, it's not gonna last you that long.
Mm-hmm.
Right.
You know, you're gonna leave somebody and okay, so they don't have to move out of their house. They don't have to sell the car. They don't have to get something repossessed.
That is so true. And I just wonder, I tried to reach out to a friend who works at one of my husband's friend who works at a funeral home. Just even with COVID, this sudden pandemic, how many people have passed in 2020 and even up till now who didn't have life insurance. So I literally know people or a family that was passing a tray around at a service. And I've seen GoFundMes to help people, take care of burial and services for family members. So it's important.
It's important. It's probably not, like Randy said, not talked about a lot. People don't want to talk about it, or people think they can't afford it.
Mm-hmm.
Right.
It's probably the other thing. But if you look at it, like you said, this is a meal. So if you don't go to McDonald's twice a week, take out 2 days out the week, that could be an insurance policy.
Yeah.
People will spend more money on car insurance than they will life insurance.
Yes.
But your life is 100 times more valuable, 200 times more valuable than the car that you drive.
Yes.
I'll tell you this, and then I'll wrap up with this. I was at a couple's house one night, and they said, well, we talked about everything for about an hour, and they said, well, we're real spiritual, so we're going to pray about it. I said, okay, let's pray. And they said, well, we're going to go back in the back room and pray, and we'll come back. So they went in the back room, and they prayed and said, well, the Lord is saying that we need to think about it. And I said, okay. I said, give me 1 second. I walked over in the corner of their house, and I got on my knees.
Well, you crazy.
Crazy. And I came back around, and I said, the Lord said you need to buy this right now.
Don't be blaming the Lord on that.
Right. You are crazy.
But I think there was a time when people felt like, looked at life insurance people like salespeople, like we're going to force you to buy something. And really that's not where I am. It's like I want to educate you and help you make an informed decision.
Right.
Yeah. Man, well, we really, really appreciate you coming and sharing this wealth of knowledge. Why don't you tell our listeners how they can contact you, start those policies?
Well, first of all, of course, my name is Randall Fears, Randy Fears, and of course, I am on Facebook, which seems like I get more people contacting me through Facebook now than ever before. My email address is Randall, RANDALL .Fears, F like Frank, EARS like Sam, @gmail.com. And then, like I said, I have been in the industry for 31 years. I represent a lot of the well-known, highly rated companies in the industry.
That's awesome. Hey, and you can reach me and Money T on Let's Talk Money on Facebook.
Handle is @GirlsTalkMoney.
And you can reach me, Simply C Melody, at Simply Custom Wood Designs on Facebook and Instagram. I also have Simply Cupcakes, where you can order some of these yummy, delicious cupcakes. And you can also check out my page that is a tribute to fatherless daughters at advocatingdaughters.com.
And you can find Money T. I have a business. I am a travel advisor. You can find me on Facebook, Priceless Destinations, and also on Instagram. And I also have a website, pricelessdestinations.com. And I have a travel store that's coming It's coming, y'all. It's coming. I'm so excited. Also, budgeting behaviors with T on YouTube. And I'm trying to get our shows posted up there. So in case you miss a show, you can go there and catch it. Make sure you hit the like button and subscribe so you'll get notifications. Also, I have a Budgeting 1.0 mini course, and you can find that on Facebook under Budgeting Behaviors.
Check. Hey, guys, you've been listening to Let's Talk Money on BSB Radio.
We out.
Just enough for the city I'm living. Just enough for the city I'm